The first observation to note is the long-term downtrend. Using a shorter interval is better for covering detailed developments regarding the recent gap up. A long interval from major swing points would be less accurate in the short-term context. The main focus will be on the support at the gap up area and when it is likely to see critical price action in these short and long-term bearish conditions. There is a moderate bullish rise, but not much has changed on the bearish outlook, as the previous highs near 23 produced expected resistance with bearish stars near the interval line at the very end of November. Unsurprisingly, the breach of the gap up area takes place close to an interval line, and a trend line is likely to result in a breach under the current Fibonacci retracement level, even though trading is in the area of the gap fill region. There is indeed a break lower, but when bearish volume drastically decreases, the final interval line of 2018 marked the first potential break to a neutral to increasingly bullish stance. As an uptrend starts, it is possible to use the same interval, but this is not suggested, since it was mainly for the shorter term context of the likely gap up fill that already finished. The current uptrend is essentially a series of retracements under the influence of the sharp drop ending 2018. This provides more recent context for a time cycle interval and a Fibonacci retracement to assess the relatively small swing points. The interval line in early June is the most noteworthy as it approximates the moderate bullish break back towards previous highs. A longer interval from the early stages of the uptrend also provided similar results. To approximate an interval line close to the end of the neutral to bullish trading, the interval line in April was of less importance, and it is normal to see lower activity, especially in a phase of flatter movement. Interval lines won't always approximate the most drastic movements, particularly when there is low activity in the middle of a continuation range. The choice to use the slightly higher downswing resulted in too long of an interval. The first downswing was more appropriate since it was the first clear retracement in the uptrend that was more suited for the context of the bullish continuation, similar to how the first retracement of a base trend for a Fibonacci extension is often preferred. While the interval lines and old Fibonacci levels can still be used, it is best to make adjustments based on the more recent context of the double top and gap down. The exact identification of the current downswing is merely a coincidence. Now the more recent context of the double top and gap down provide more valid price and time analysis. After the November gap down, the more neutral movement had about 1 week until a major event could happen. When flat trading continued, the next major event was likely to happen closer to early December, near the next interval line. After the gap down in early 2020, a neutral to bearish phase was likely if no upswing formed by the start of March near the next interval line. A shorter interval from the first half of the double top is mainly for short-term developments until the first upswing develops by September. However, the interval lines usually quite accurately approximate many major events, especially the gap down much later on. This is possible, but much less common with a shorter interval. Although there are similar results, it is not technically correct to use a large gap down candle that temporarily halts a downtrend. It is more correct to use the neutral to bullish phase of 3 methods falling price action. However, it is theoretically most correct to use clear swing points. That is why a steep downtrend in development like this will often use intervals from the final swing points in the preceding uptrend for an interval, since no clear swing points are available after a gap down and further bearish acceleration. The minor first upswing in the double bottom after the gap down is the absolute minimum for a valid swing point to get an interval. Using the second upswing point in the double bottom is also correct and produces similar results. Even if an interval is highly accurate, it is not realistic to expect every interval line to capture every significant event on the chart. That is demonstrated by the variation of the two intervals from the upswings of the double bottom. An interval from the second half of the double bottom demonstrates this idea further, and was the most direct use of context from the double bottom that applied to the gap fill and break under the 15 boundary in February. The lowest point of the double bottom to the peak of the gap fill is a bearish situation. That is suitable context for an interval to be applied to the bearish continuation. Unsurprisingly, the 1.618 projection level marks the approximate development and continuation sections of an uptrend, reversing the steep drop. A shorter interval from the peak of the gap down fill to the first bullish retracement is once again more for the short-term developments that are most effective during the duration of the downtrend, but less effective after neutral to bullish price action emerges much further in the future. Extending cyclical lines can often crowd a chart, especially with a short interval. That is why it can be useful to remove cyclical lines after they identify intersections with price levels, or only use a few vertical lines to mark the positions of upcoming intervals in the near future, instead of endless extensions of cyclical lines.